Apparently, we might be heading into a recession because men aren't tipping strippers. I know how that sounds, but before you laugh it off, here's the thing. Historically, when discretionary entertainment spending drops, especially at strip clubs, it's actually been a pretty reliable signal that broader economic trouble is coming. And right now, strip club revenue is declining across major markets like Las Vegas and Atlanta. This isn't a joke. It's called the Stripper Index, and while it sounds ridiculous, it's taken seriously by some analysts as a leading economic indicator. So what's really going on here? Why would strip club revenue tell us anything useful about the economy? And more importantly, should we actually be worried? Let's break it down. What is the Stripper Index? The Stripper Index is an informal economic indicator that tracks revenue at strip clubs to gauge the health of the economy. It's not published by the Federal Reserve or tracked in official reports, but it's been around for decades, whispered about by economists, traders, and industry insiders. Here's why it matters. Strip clubs measure pure discretionary spending in real time. Nobody needs to go to a strip club. It's not groceries, it's not rent, it's not even a nice dinner. It's entertainment spending at its most optional. And when people stop spending money on things they absolutely don't need, it's often one of the first signs that they're tightening their belts. But it's not just about the average guy cutting back on a night out. The real signal comes from a very specific group of customers. The whale theory. Strip clubs don't actually run on $1 bills. They run on whales. In the industry, a whale is a high net worth individual who drops thousands, sometimes tens of thousands in a single night. These are business owners, executives, traders, real estate developers, people with serious disposable income. And their spending habits tell a very different story than the average consumers. Here's the key. Whales are the first to pull back. Why? Because they're closest to the money. They see their stock portfolios fluctuate. They track their business cash flow weekly. They feel shifts in the market before those shifts show up in official data. So when a whale who used to spend $5,000 on a Friday night suddenly stops showing up or starts negotiating prices, it's a signal. It means the people with the most extra cash are getting nervous. And that matters because their behavior predicts what everyone else will do 6 months later. Think about it this way. If someone worth $10 million is suddenly worried enough to skip the strip club, what does that say about the person making $80,000 a year? They just don't know it yet. Now let's talk about why this indicator is actually useful compared to the official numbers we usually rely on. Most economic data is lagging. GDP? That tells you what happened last quarter. Unemployment rate? That's backward-looking too. By the time those numbers confirm a recession, you're already in one. But strip club revenue is high-frequency data. It updates daily. Dancers know by Thursday night whether the week was good or bad. Club owners see the trends in real time. There's no delay, no revisions, no waiting for a government agency to compile and release a report 3 months later. Right now, dancers in Las Vegas and Atlanta, two of the biggest markets in the country, are reporting something alarming. Clubs are empty. Customers who used to be regulars are gone. And for the first time in years, clients are negotiating prices. That last part is huge. When someone who's been spending freely suddenly starts haggling, it's not about the money itself. It's about their mindset. They've shifted from, "I have plenty," to, "I need to be careful." And that shift, that psychological change, happens before the economy officially tips into recession. Here's where it gets bigger. If strippers aren't making money, they aren't spending money, and that creates a ripple effect. Dancers spend their income on hair, nails, makeup, cosmetics, luxury goods, rent, car payments. When their income drops, they cut back. Salons lose clients. Retail stores see fewer transactions. Landlords see late payments. This is the multiplier effect in reverse. In a healthy economy, one person's spending becomes another person's income, which becomes another person's spending, and so on. But when that cycle breaks, it works the other way. The decline in tipping at a strip club becomes a decline in spending at a boutique, which becomes a decline in orders from a wholesaler, which eventually leads to layoffs in totally unrelated sectors. Strip club revenue isn't just measuring one industry, it's measuring the leading edge of a wave that's about to crash through the entire service economy. The lipstick index, when small luxuries tell big stories. Now, the stripper index isn't the only unconventional indicator flashing warning signs right now. There's a whole family of these small luxury indicators, and they're all telling the same story. Let's talk about the lipstick index. The theory goes like this. When economic anxiety sets in, people stop buying expensive dresses and luxury vacations, but they still want to feel good about themselves. So instead, they buy a $30 lipstick. It's a psychological boost without the financial commitment. This was coined by Leonard Lauder of Estee Lauder back in 2001, right after 9/11. He noticed lipstick sales surging even as the economy tanked, and it worked as an indicator for decades. Lipstick sales spiked during the Great Depression, after 9/11, and during the 2008 recession. But here's what's happening in 2025 that should worry you. The lipstick index is breaking. Major cosmetics companies like Estee Lauder, Coty, and L'Oreal all reported disappointing sales this year. Estee Lauder saw a 10% drop in net sales. Coty declined 6% and announced 700 layoffs. Even L'Oreal, which usually posts double-digit growth, managed only 3.5% this quarter. So why does that matter? Because if people aren't even buying lipstick anymore, the ultimate affordable luxury, it means they're not just cutting back on big purchases, they're cutting back on everything. There's a twist, though. Sales at places like MAC and Sephora are actually up about 15%. But here's the catch. People are buying cheaper products. They're trading down from $50 luxury lipsticks to $15 drugstore brands. They're skipping the full face of makeup and just buying mascara to make their eyes look good behind a mask. This is what economists call trading down, and it's one of the clearest signs that middle-class consumers, the backbone of the American economy, are feeling financial pressure. And it's not just lipstick. Hairstylists are reporting that clients are switching to low-maintenance styles. They're calling it recession blonde, highlights that don't need frequent touch-ups. Nail salons are seeing the same thing. People are spacing out appointments or doing their nails at home. These are small behavioral shifts, but they add up to a pattern. When someone who used to get their hair done every 6 weeks starts stretching it to 8 or 10 weeks, that's not about preference, that's about cash flow. And when millions of people make that same decision at the same time, industries start to feel it. Salons lose revenue, product manufacturers see slower sales, and eventually those businesses start cutting hours or laying people off. The lipstick index isn't dead, it's just evolved. The signal is still there, it's just harder to read, because now instead of people buying more lipstick, they're buying cheaper lipstick, or skipping it entirely and buying lip balm instead. Either way, the message is the same. People are worried about money. The gig economy canary, when delivery drivers stop getting tipped. There's one more indicator that's been quietly screaming recession for months: delivery driver tips. Remember how we talked about whales pulling back from strip clubs? The same thing is happening with everyday consumers and food delivery. And it's happening right now. DoorDash drivers are reporting something alarming. In 2022, drivers averaged about $7.50 per hour in tips. By 2025, that's dropped to between $5.90 and $6.50 nationally. That's a decline of 14 to 22%. In cities like New York, it's even worse. Some drivers report tip declines of 30 to 50%. Orders that used to come with a $5 or $6 tip are now coming through with $1 or $2, or nothing at all. And here's why that matters. Tipping behavior reveals confidence. When you tip generously, it signals abundance. It says, I have enough and I can afford to be generous. But when you start cutting tips or eliminating them entirely, it signals the opposite. It says, I need to hold on to every dollar I can. This isn't about people being cheap, it's about people being scared. Think about it. The person ordering DoorDash isn't struggling to eat. They can afford a $25 restaurant meal plus a $5 delivery fee, but they can't afford to tip $4 anymore. That tells you something about their mental state. They've shifted from money is flowing to I need to conserve. And just like with strip clubs, this creates a cascade effect. When drivers aren't getting tipped, they start declining orders. The low-tip orders sit at restaurants getting cold. Customers get angry. Restaurants lose business. And eventually, drivers quit and find other work. The whole ecosystem starts to break down. But here's the bigger picture. Delivery drivers are the real-time economic sensors of Main Street America. They interact with thousands of customers across all income levels. They see who's ordering out and who isn't. They see who's tipping and who isn't. They see the patterns before anyone else does. Right now, those patterns are telling us that consumers are pulling back. Not just high-net-worth individuals, not just whales at strip clubs, but regular people ordering dinner on a Tuesday night. When a middle-class family in the suburbs starts cutting their DoorDash tip from $5 to $2, it's not a crisis. But when that same behavior spreads across millions of households, it becomes one. Because that $3 they didn't tip, they're probably not saving it. They're using it to cover rising credit card bills or higher grocery costs or the fact that their rent just went up again. The gig economy was supposed to be about flexibility and freedom, but right now it's becoming an early warning system for economic stress. And the warning is getting louder. So when you see a DoorDash driver report that their income dropped 20% this year, don't write it off as anecdotal. It's data. Real-time, high-frequency data about consumer confidence and spending behavior. And that data is saying the same thing the stripper index is saying. People are scared, they're pulling back, and the economy is starting to feel it.